We're seeing valuations getting significantly more extreme. And really, what have we got so far? We've got hope of a reflation story, which was already pitched pretty much there in terms of, if you look at the US economy, unemployment rate was falling to getting close to inflationary levels anyway. Now we've got this promise or hope of a fiscal stimulus coming through, and that obviously helping to accelerate growth, but it will put upward pressure on inflation. So yes, we're moving from a muddle through to a reflation story. The market's priced a lot of that in, I think, from a short-term perspective. So actually what we're advising our clients to do is to look at the bond markets and saying, actually, probably from a short-term perspective, we expect the 10-year Treasury yield to peak out around 2.4, 2.5% in the short term. So that offers an opportunity. If we get back to around 2.15, 2.2, then we'd probably use that as an opportunity to switch into the equity story. So probably not at the right time to chase it today.
But the bond market itself presents a lot of opportunities right now, doesn't it, Dave? A lot of investment-grade corporate bonds with attractive yields, attractive returns, then have gotten a lot more attractive because bonds just became no-no for a while there, and they were sold AAA all the way down to CCC, all in one go, it seems.
Well, I think actually what's interesting is if you look at G3 government bonds, they still delivered positive returns this year. So despite everybody being very concerned, and obviously Japan has helped that with the currency performance. But overall, the year-to-date performance is actually still positive. But absolutely, if you're looking at yields today versus where they were 2 months ago, they look incredibly attractive. Again, we could see that dip in yields supporting investment-grade bonds and high yield alike. But over time, we would be looking to reduce interest rate sensitivity. And our preferred way to do that is actually to increase an allocation to US high yield bonds, which obviously a lot less yield sensitive or interest rate sensitive due to the higher yields. Oil prices we're bullish on, which is good for that segment as well. So overall, that's the area that we'd be focusing on within a bond allocation, together with floating rate bonds as well, which obviously then benefit when the Fed starts hiking interest rates again.